Good morning, everyone. This is Josh Carr at The Real Angle, and today I am speaking with Kevin McCarthy at Southmark Capital. How are you doing, Kevin?
I'm great. Thanks. Hope
Great.
you are.
Beautiful. Beautiful. So, one thing I always like to tell everyone before we even get started, your web address is southmarkcapital.com, right?
Yes.
Beautiful. Okay. Yeah, I always like to tell everyone that because invariably people go on the internet and want to know who's this Kevin guy. So let's start with the intro. Where are you based?
Wilmington, North Carolina.
Beautiful part of the country there. And tell me a little bit about Southmark. How'd you start it? When did you start it? What do you guys do? All that kind of good stuff.
Sure, sure. Southmark's alternative asset manager. We started in 2009. Prior to that, I spent 10 years running a family office. And that family office came about from orchestrating a leveraged buyout of two families in a regional development slash commercial company. And
Okay.
they had been successful for 35 years. They didn't want to force their family members to have to work together. And so they made the decision to separate. And we did a leverage buyout. And when I got completed with that, the minority owner asked me to come on and try to try to get rid of all the debt I put on his balance sheet. And in the process, he liked how I structured the investments and said, "Why don't you stick around and run our family office?"
Nice.
And during that time, had a lot of different partnerships. And one of the companies that they had partnered with on several transactions was Land South. Land South had gone back to the RTC days, and they purchased that from banks. They partnered with Cargill during that time. Cargill went through a change, forming Carval, and it opened up a unique opportunity. So in 2009, we already saw the issues coming with the great financial crisis.
Yep.
It had a lot of opportunities to work together, and so I went to both principals, the principal of Landmark, the principal of Land South, and said, why don't we set up Southmark, and why don't we see if we can capitalize on the opportunities coming? And so Southmark was just Landmark and Land South, and we combined the South and the Mark. And for the next 5 years, I worked essentially for those two principals.
Well, it's funny how these names of businesses get created. A lot of times it starts as a placeholder and then you're still using it 10 years, 15, 20 years later.
Yes,
Um, and so by alternative investment manager, I mean you're doing real estate obviously, but you're doing my understanding is you do a lot of distressed debt, restructuring, bridge. Is that kind of a good description of what the kind of stuff you guys are doing?
it is. I described it always as opportunistic and value add. The opportunistic side is buying the debt from the banks. And up until 2012, 2013, there was always debt being sold by the banks.
Yep.
Once we got into the 12 and 13, there was still debt moving, but a lot of times it was being restructured at the bank level. We dropped interest rates. We created a note A and a note B, and what we started to do at that time is we started working directly with borrowers. And so got really got good at coming in on the borrower side, restructuring their debt,
Right.
um, and learning really the intricacies of lending. Just by if you do something long enough, you have to get better.
Yeah, no, it's funny. I mean, I'm not an attorney and I don't pretend to be one, but at the same time, if you read enough contracts, you start to put things together. You start to notice, gee, I've not seen this clause before. So, what was it like going from working with banks to building your own origination pipeline? Because that sounds like a very different experience.
What's interesting is that through this process, I worked just in the Carolinas, Georgia, and Florida. Um,
Okay.
great relationships because of I've restructured over 1,000 notes, and fortunately I've never had to foreclose on any of them. One thing that's unique is that as I restructure it, I leave a little money on the table for the borrower. And so the position I've always put myself in is if you pay me off, I do okay, and if you don't pay me off, I do really well. And so I'm in a great position to have some flexibility. It
Right.
also it also develops these incredible relationships because I have competition that doesn't take that same approach. It's come in and try to extract every single dollar you can. And so through that process, I've developed a great referral, great network. And there's always distress. Distress happens because somebody overpaid for an asset. Distress happens when somebody goes through a divorce, somebody passes away. Um, Distress happens when we went through COVID and all of a sudden people aren't working in office buildings any longer. They're
Sure.
working at their homes. So through that process, there's a pipeline that is always moving. And if you have the right relationships and you have the insight and you have the experience, and most importantly, if you have the capital, there's opportunities that come across your desk every day.
Fair enough. Fair enough. So typically, so let's talk about sort of natural competitors. I mean, you're competing against other bridge lenders, I imagine. You're not really up against banks. You're kind of in that bridge lending universe, if you will.
That's correct. That's
And
correct.
and my impression of most bridge lenders are that they're not relative. I mean, they're basically usually local players, right? Or do you really see national guys in this space? Seems like it's always been very focused on sort of local entities.
Well, I saw a statistic that showed, after the great financial crisis, the last decade, we doubled the amount of private lenders inside the marketplace. We've gone from somewhere around 44 billion to 200 billion. And part of the reasons is that the big banks got caught up with all the regulations that came out. And the regional and small banks and the private lenders filled the space. And
Right.
what I've always done is I've competed at a level that's been underneath the big guys. So your big Wall Street firms that are coming in, that are looking for large transactions. I've stayed in maybe that $3 to $10 million range.
Okay.
And when you're floating around in that range, you are dealing against a lot of local individuals,
Sure.
and you're also dealing with people that, what I did early on is I put my money into what I set up, and then I brought a partner in. And so I was investing my own money. And the beauty of that is that I could go talk to somebody. I could essentially make the decision. It was a phone call away to confirm that we were going to do it. Whereas a lot of my competition, they're more or less a broker that's having to then go try to call somebody to try to put them in place. And so with speed
Right.
and certainty, I can beat them out. And if I stay underneath that radar screen of the big guys, then I can be extremely competitive.
Right, and I'd also imagine you have a better understanding of the Carolinas than someone who's only just flown down there 2 days ago. So, I mean, there's a lot to be said for the local market knowledge.
Well, we try to say if you have boots on the ground, you
Yeah,
know,
no, no,
if you've been traveling up and down the road for 30 years, if you've watched how the market has evolved, if you don't get stuck in thinking that just because it hasn't happened here, it will never happen here,
sure,
then there's two sides to that coin. And the other thing that we've done is that we've been extremely flexible, and so we've done value add. So, when the great financial crisis hit, we went into Atlanta. We bought hundreds of loans. We restructured those loans. Those were anywhere from loans of developers that had walked away, builders that were in trouble. And then we restructured them with national builders and worked our way out of it. And then somewhere around 2014, we completed that, because what happens inside those markets is everybody figures out where the opportunity is. They drive up the price and the yield goes away. And so as the price drove up, people moved in. That's the time that I set up third party management with Southmark. So 2013, 2014, brought in outside investors. And then I saw an opportunity with suburban office, and it just was mispriced. And
okay.
so ended up buying 10 office buildings, selling the last one in December of 2021. And the opportunity was that there was just a great value add, um, through that stretch.
And
And
that's
so
interesting. So you've done bridge lending and you've also taken equity positions, which is not the typical bridge lender sort of MO, if you will, which I think speaks to the flexibility. I mean, it sounds like as long as you're in your market, you're willing to sort of be in the you. It sounds to me like the debt equity line is not as firm as it might be at other lenders. I guess would be
yeah,
the
the
way to
beauty
put
is
that.
that I spent 14 years learning how to develop. And
Right.
and so I'm a developer investor first, a lender second.
Got it.
And so the properties that I cherry pick, or the deals that I look for, are deals that I'm completely comfortable owning long term. And so the opportunities are when I step in and I bring capital to the table, I also bring expertise. And so I can ride co-pilot and assist or make a few comments here or there. I'll give you an example. I had a developer that had a lot of residential lots.
Hmm.
He was trying to sell those residential lots to the retail market.
Okay.
That's a difficult sale to make because the retail buyer is coming in and they want to see a house, they want to touch a house, they have a difficulty visualizing.
Sure.
So I subordinated one of the lots, had him, gave him the financing to build one of the homes. And then for a project that hadn't had any traction or sales, all of a sudden he sold out in 8 months. And again,
Right.
it was just from experience of saying you're going about it the wrong way. His broker thought it was great to put, 25 lots into the MLS, but they were advertising the wrong direction. And
Yeah,
so that
and
was a simple move.
the fact that you were, I mean, to paraphrase, the fact that you were flexible in rejiggering the financing and giving them some additional proceeds just to get the model home up, whereas another lender would have just said, "I lent you the money, just pay me, we're done," and I don't really care. You were caring more about the overall viability of the project, which makes a lot of sense. Yeah,
Yeah,
and it's and your point about homeowners, your typical buyer buying a lot, yeah, you're dead on right. I mean, people will buy a lot and then they'll stare at it because they don't build for a living. They don't know how to get the thing built. Yeah.
and I'll give you another story that was we had a huge project in Atlanta that we purchased, and it involved two large banks.
Okay.
And so we bought half the project from one bank. The other bank we approached, we had a relationship with, and we wanted to buy their note as well.
Sure.
They politely declined.
Okay.
They they kept their price above market. And so we came in, we gave the developer $50,000 to come in and do all the landscaping. We started to sell the houses because our comp was their product, which was the same house, except ours was at market $100,000 cheaper.
Right.
So all of a sudden, our houses start selling 25 a month in a market that's not having any sales.
Sure.
So then what the bank does is they drop their price below ours. And when they drop their price below ours, the market thinks there's something wrong with their houses and it accelerates my sales up to 35. And so the example is again, this is a business that you need experience, you need insight, you need relationships, and then you need capital. And if you have all of those and you've been doing it for a long time, you understand what's happening inside the market. Unfortunately, if you don't understand that and you're sitting in an office and you haven't been out to the job site or you don't understand what's happening, those are the areas that we've been able to capitalize and do very well.
Yeah, no, and I think that's all dead on. I mean, making the point that it's not just a financial product, right? It's not just numbers on a screen, it's not a stock or bond, it's a physical thing. You can walk at the site, you can walk the site, you can look at the view lines, you can look at
Right.
the finishes, you can actually talk about a physical good. And if you don't understand that, you fundamentally don't understand real estate. It's people forget that it's a physical good. So product type wise, I mean, I've heard us talk. We've talked a bit about apartments. We've talked a bit about office. Are there other product types that you just won't touch, either because you just think they're a dead end, or you just don't want to even get into them because you don't understand them or want to understand them? Any product types you just don't do?
Great question. We do office, we do residential, which mainly is apartments. We do light industrial.
Okay.
And then outside of that, we don't touch other product types. And it's not because I don't like other product types. I think the shopping center model is fantastic. Obviously, industrial is wonderful. You've got the lowest occupancy vacancy rates. You've got a great client. You've got
Sure.
you've got a great trend coming. But what I've learned is that real estate it's difficult enough with the properties I've been working within for the last 30 years. You appreciate as you continue to work in it. I think it humbles you a little bit of how much you need to know. And also sometimes the luck that you have in a situation. And to think, when I come across a shopping center loan or a deal, I have great shopping center relationships with individuals and I call them up and I can just move the loan to them if that's what they want to do.
And one of the reasons I always like to ask this question is because often I'll say to people, what product types do you do? And they'll do everything. They say, oh, we do everything. And then I
Right.
say, well, what about hotels? They go, well, no, I never touch hotels. I'm like, well, then you don't do everything, you know?
Right.
Which again, there's no knock on that. I mean, hotels are great, but like I've never managed a hotel. I've never operated a hotel. I don't know anything about hotels other than as a consumer of hotels, you know? So I'd
Yep.
be foolish to do a hotel loan. I mean, again, I think, I'm here to talk to you, but I will share one funny anecdote from my own life. A colleague of mine who does boutique hotels, I used to rent him a desk in my office because he needed a place to work. And he came to me one day and he said, I'm trying to figure out what nuts should go in the mini bar. We're going to have a nut tasting in the conference room. And he brought in like 80
Yep.
kinds of pecans and almonds and all this sort of stuff. And we sat there like idiots at lunch, taste testing nuts. And my grand conclusion was to say, you know what? You do hotels. Like I don't have the patience for this. I would kill someone if I had to worry about what kind of pecan I had to put in the minibar, you know?
Right. Right.
But that matters. It matters for that. For you and I, not so much. But
Well,
but anyway,
well, the beauty for me is I like to own real estate first. If I can own it, that's fantastic.
sure.
And when I'm looking to own real estate, the advantage I have is that I'm in the marketplace I'm looking for property, for lack of a better term, that has a couple issues with it. And those issues could be something as simple as that the owner doesn't have the capital they need to put back into the property, or more importantly, to be able to do the right leases because they can't do the right marketing.
Right.
It could be that it's an owner that has hired a third party to manage it. The third party just isn't doing a great job. And because they're not walking the property, they don't see it. And so as I continue to circulate through the market, I have a list of properties I'm interested in, and then I make offers on those properties. And eventually, 90% of my business is off market. And the lending piece comes about, I set up for lack of a better term, a $20 million partnership in 2017. And the reason I did that is that the market had gone up to a level that I thought you were losing. Your risk reward ratio wasn't good. And so I started lending money off just balance sheet lending on real estate, and we did extremely well. And then we blew through the 20 million. So we set up a $50 million partnership. And again, it was all predicated early on. I had some great mentors, and it said, why don't you just swim downstream? Pay attention to the market, don't fight the market, understand the market, and then just respond to it.
Yeah, so I mean, you talk about funding. So basically, you're a balance sheet lender at the end of the day. You're basically
Yes.
lending your money. I mean, you're
Yeah.
not brokering the loan out, which really does make you more like a traditional bank. But I guess instead of having a bunch of little depositors, you have, for lack of a better way of putting it, one or two just big depositors, essentially,
Right.
and you're deploying their cash, which makes a lot of sense.
And the beauty is the deals that I'm setting up, I'm probably on average less than 50% loan to value.
Right.
And I'm a quicker source for somebody. I'm a trusted source because of my history. And again, for me, if for some reason something goes wrong and I have to take the asset back, I'm going to make four times what I'm making, and I'm already making a great return. And so,
Right.
and so the beauty of the model is that you can make it. You can do really well for your investors. You can sleep well at night because if something really does go wrong, you're going to do even
You
better.
can still reposition it. You can do other things. Yeah. Yeah.
And then you just do everything you can to help them get where they need to be. And if you help them get where they need to be, you'll do well, they'll do fine. And next thing you know, your phone will ring again.
And maybe I'm reading between the lines here, but one thing I we haven't talked about is it sounds to me like the borrowers that you're dealing with, it generally sounds to me like these are capable people who just got in a bad situation rather than they just should have never been doing this at all. You
Correct.
know? I mean, we
Correct.
haven't really addressed the competence issue yet, but like we've talked about the real estate, we've talked about am I correct? I mean that's I'm on point here, right?
You are. And
Okay.
the other thing about our industry is that we go through a boom and bust cycle. It takes 12 to 15 years usually. And
Right.
during that cycle, it becomes too easy. And when it becomes too easy, you bring in, again, my opinion, you always have the desire to make more money. But then you have this other factor that comes in, and that's the envy. So when the guy across the street is doing it and he's making easy money, and we did it through the financial crisis when
Sure.
when people own 6, 7, 8, 9 homes, They
Right.
were never planning on living six, seven, eight, nine homes, but they were getting the financing. And I think again, I think I think all the pieces are coming together again for an incredible opportunity because we've repeated some of those mistakes.
No, and
And
your point about boom and bust is well taken. I mean, look, when things are good, envy's powerful. If you're building a big building, I want to build a bigger building because, of course, I do. It's and so yeah, you do definitely see people who are capable professionals get over their skis, so to speak. Um, no, it's a very healthy attitude. I mean, I don't know how else to put it. I really enjoy the way that you're sort of seeing it. So so what sort of we talked about deals that work for you, and the secret sauce here really just comes down to, I think, local market knowledge, competence, building those relationships,
right.
harvesting those relationships. Um, what kind of deals are good but you don't do? Like what doesn't work for you, I guess would be a way of putting it. Like for your funding source. Are there deals where it's just going to take too long to execute? Like, we talked about product types, certain product types just don't fit, out of market. What else? Anything
Out
else?
of market is key. I've looked at a
Okay.
lot of great deals in Nashville, Tennessee. I think it's a fantastic city, fantastic trend. Too
Sure.
hard to get to. I try to stay in a position that I can be at a property within 6 hours, and if I can get to a
Right.
property within 6 hours, I know if an issue comes up, I can be there. I think, you know, the challenge is walking away from deals that are fantastic. I do a lot of work in Raleigh, Durham. There was an incredible piece of property that had a few issues with it. It was being cleaned up. I knew that it was going to be approved, and it was a piece that sat in a great location. The challenge is it's land, and so when you buy that land, you have to turn around and sell it to somebody else, or you need to develop it. And the problem I had is that I always have two exit strategies on every deal that I do. And
Right.
that one I could only come up with one exit strategy. Now I'll be honest, that deal ended up making the buyer $100 million, and they made it in 3 years. So I was spot on of what the deal was. The problem is there was only one way to go. And so with only one way to go, you're leaving, in my world, you're leaving the investor world and you're going into being a speculator, and that's a dangerous place to be. And so those are some deals that you're 99% sure that deal is going to work out fantastic. And that's a great deal if I had more capital of my own and I wanted to put it in a generational investment, because I knew, maybe it doesn't happen in my lifetime, maybe it happens in my family's lifetime. I
Right.
just wasn't at that position. And so because I wasn't at that position, I had to walk away from it. And you know what happens in real estate, and I'll get back to the envy,
Yeah.
is that I was at a football game, and the gentleman that was in the same box as me was the guy that did the deal. And of course, he he didn't know my involvement in it, but he proceeded to tell me the whole story about how great of a deal it was.
And all you can say is congratulations. I mean,
Yep,
right? What
that's
else
it.
can you say? Good for you. I mean, good for you. Yeah. No, I think unfortunately, it's the one that got away, right? But at the same time, you don't have to do every deal. There are lots of good deals you do.
What-
It doesn't have to be
From
yours.
my experience, that what I've had is I put together a plan A and a plan B, and what I've learned is that 80% of the time I'm on plan B, and then 10% I hit plan A, and 10% I hit plan C. And because of that, I've realized I'm just not that good if I'm only going to have one plan. And
Right.
so, and what's interesting is some of the best deals I've done over the last 10 years, we've got a great track record. We closed over $100 million in 10 years. We still have another 25 outstanding. We made 25.5 million in profit. Our investors made 18.5% IRR net of fees. But what's interesting is that the lowest deal we did was 8.5%, and I did a lot of work for that deal, not to make any money. But the best deals that we did for the investors were close to 30%, and both of those deals had problems.
Right.
And
Because
and
nothing
when
ever
we
goes
had to get
expected.
involved and figure out how to solve those problems, we actually did better than what we would have done if we hadn't had those problems. And so what I've learned is that I'm not very good at predicting the future. I'm better at understanding where the market is today. And once you understand that, for me, I've got to have two exit strategies. And if I don't, I just can't move forward.
No, yeah, and your point on predicting the future is well taken. I mean, look, take COVID. I mean, that was on no one's radar screen because how could it be? It was like something out of a Hollywood movie, and then it happens, and they're all staring at each other, saying, "Well, now what the heck do we do?" And those uh, those once in a lifetime type events seem to happen with alarming alacrity. They just keep happening because you can't predict. How could you? So speaking of things you can't predict, I mean, interest rates have spiked. Maybe you could predict that because the government printed money like it was going out of style.
Right.
How's that affected you guys in terms of loans you're making? I mean, obviously you raise your rates, but has there been a slowdown in your activity because rates are higher? How has that affected your business?
Well, I think it's fascinating to think that, the rates have gone up 500 points in a very short period of time. And so clearly, the value add model that was great for 20 plus years, that's a tough model to pull off today. And
Right.
also, the ground up construction is very difficult to do today. And then couple that with the fact that the banks took, we had a zero rate interest rate policy. The banks took excess deposits and invested them in other areas that are now causing some challenges for them. And you've got the office market that, you know, we're still repricing assets. And, back in the great financial crisis, I remember somebody said, well, the banks just over leveraged everything they did. And I said, I don't think it's over leveraging. I think it's just mispricing of assets. And we've done it again. And
Yeah.
so as we start to see the pressure mount and the challenges that are coming today, the opportunities I get calls every single day to fill the capital stack on construction because we're still short housing units. The challenge is that we have an incredible supply coming into certain markets. Rents are negative. There's some pressure for those that don't have the right capital structure. And you
Right.
know what I learned in the distress side is that you need to plan for those unexpected surprises. So, our last office building we bought was in November of 2019. It was 63% occupied. We turned the corner in February. We are 85% occupied. We are heading to 100. We
So
we had
things are moving in the
surpassed.
right direction. Yeah.
COVID hit. We bled all the way back down to 63%.
Sure.
And then because we had capital, we were able to execute the plan that made sense in the marketplace, and we jumped ahead of a lot of people, leased it up to 100% and sold it in December of 21. And so my point is that today in the marketplace, if you don't have capital, or if you have a great piece of property and you're trying to build that. I get phone calls every day to add money to the construction. The problem is that you have to understand is what's that asset going to be worth when it's built.
Right.
And
Or are you already underwater and you're just not? You're throwing good money after bad. And also, I mean, supply chains are still messed up. I mean, at the end of the day, you can't just get the materials you need, so everything's taking longer than it should. So, yeah, it's fair enough. Fair enough. Fair enough. But no, it's as you said, it's just a matter of making things pencil, I think, with construction costs being
but
uh what they are.
but I will add, I think the opportunity and what I'm working on is that I just did a preferred equity investment for $17 million and in an apartment complex that is almost completely constructed.
Hmm.
It'll get its last CO here in 2 weeks.
Cool.
Fantastic location. Best location in the marketplace, not a lot of competition. It's leasing up ahead of schedule. And the challenge is that the developers had two other projects coming out of the ground. And those projects had already started. The banks had promised one number, the market changed, so they were short capital. And what they were looking at is one of my competitors on Wall Street to recapitalize this project that they had. I stepped in and said, instead of doing $52 million, why don't you look at doing 17? Or I'll do preferred equity. I'll be on top of the senior loan. My cost at the end of the day is going to be on par with what Wall Street's offering.
Right.
But where I'll have an advantage is that I'm going to go see the property every week. So I
Right.
don't need you to do certain things that they're going to need you to do because they're sitting in New York. And so those are the opportunities. I think in this marketplace, it's incredible the opportunities that we have in front of us.
Well,
And then again, depending on where it goes, it could be a repeat of what we dealt with back in 2012, 2011.
yeah, it keeps repeating itself. It keeps repeating itself. So plans for the next year or two, just as we think about where you're going. I mean, we talked about sort of as things are evolving, your comments about where we are as state of the market, I think is well put. I imagine you're raising more capital. Like what's going on that front? Like sort of
Oh, it's.
strategy stage.
Sometimes in life you don't get a second chance. And back in the 2009, I set up the structure, I established Southmark. We had capital. We also had great relationships,
Hmm.
and we were approved with the FDIC for the PIPP plan.
Yep.
And an opportunity came up on a $50 million. It was a portfolio that was 200. No, it was a portfolio about 150, and it ended up trading for about 50. And and I and what I realized at that moment that I didn't have the right capital structure, because what I had always done is I had just relied on deal by deal.
Hmm.
And so, you know, I had the relationships, I had the insight, I had the expertise, but I did not have the structure. And the structure needed to close that deal was to have the money at the table at the time. And unfortunately, I lost that one to Blackstone. And I tracked that one afterwards. That was an incredible opportunity. So what we're doing this time is we're in the process of raising $150 million. We're about a third of the way there on the fund, and it's
Exciting.
just be in position to take advantage of right now the opportunities that exist in the marketplace. Do 10 more of the preferred equity investments we just did, but also to be in a position that if something happens because of the tightened bank lending environment that we're in, if something breaks, back in the great financial crisis, we dropped interest rates to zero and people could make their payments, and it was the old pretend and extend and things floated along.
Yep.
Today, the model of pretend and extend when interest rates are where they're at is going to be a little bit different than it was back then. And so it may force some transactions to happen. So we're trying to see if we can't get in position to take advantage.
Yeah, and and your point about lenders is, it's not just what the rates are, it's whether or not lenders are lending. And a lot of banks right now, because of their own internal capital issues, they're just not liquid. They just can't put out
Right.
the money that they want to. So even if a loan comes due and you say fine, I'll pay you, 7 instead of 5, they still just may not be able to lend the money because of their internal capital issues. And I think that's what people sometimes don't understand. It's not just about rates. And your point about how the private lending market has grown, that's why. I mean, because if a bank won't lend me money, well, I need to get it from someone. So now what do I do? It's interesting. It's definitely interesting. No,
Yeah.
I've been asking people this question because I think the next 12 to 24 months we're all trying to figure out where where are we going and what will it look like. There seems to be a real lack of clarity. So
Right. Right.
cool. Well, look, this has been great. It's fun to talk about the non-traditional lending market, though. It's funny when you talk about, your comments about how it's a $200 billion, $200 billion lending market. It feels weird calling it alternative because it's sort of like, well, is it really alternative if it's $200 billion? Like that's not a
Right.
maybe
Good point.
maybe I'm showing my age, but I remember when Nirvana was the biggest selling band in America, and
Uh-huh.
technically they were alternative. I'm like, well, if you're the biggest selling band in America, by definition, you're not alternative, you're
That's
mainstream.
right. That's
So
right.
that's kind of where you guys are. And if I could leave you with anything, maybe you guys can be the Nirvana of lending. They're worse people to imitate, just from my own musical tastes. Nonetheless, thanks again for joining me, Kevin. This has
Thank
been
you.
very constructive. And again, that's southmarkcapital.com, Kevin McCarthy. Great. Thanks again.
Thanks, Josh.